So what mistakes are developers making at the moment?
So I think for me, probably the best way to answer that is to say that development is a long-term game. The cycle of a typical development project is 2 to 3 years, and so I think as a developer you always need to be looking forward to see what's going to be happening in the market. And so I think one of the ways that you can guard against risk on development is to diversify what you do. And so I suppose in a way the way that I would answer that question is that one of the mistakes that some developers are making is failing to diversify enough. The thing is, you can't predict exactly what the market's going to do, and so one of the reasons that we develop in London, Gloucestershire and Kent is that the different markets in the UK or different regions move at different speeds. So the market in the West Country is quite good at the moment, particularly in and around Bristol. The London and the South East market is quite flat. So having a presence in different markets gives us the ability to sell in some and then buy in others, so take advantage of market cycles. And so one of the reasons we built up an investment property portfolio was because I was aware that property development does go in cycles. There are times there will always be another recession. Property tends to boom and bust. And so you need something to see yourself through those times when you can't do property development, and that's something that served us very well in the global financial crisis. Other ways in which we've diversified have been to bring in different forms of finance. So we've brought in more equity. We're less reliant on debt, so that de-risks our projects. So that's working with investors, but also the focus on commercial projects. Is about, again, another form of diversification. When the residential market isn't working, what we're looking for is other safer forms of end use that still allow us to do development. So I think for me, the key thing that developers can do to protect themselves against the cycles of the market is to diversify and to look for opportunities in different areas maybe than the ones they've traditionally relied on. That's certainly what we've tried to do. Yeah. Does that help?
Yeah, definitely.
Yeah. Good. Yeah.
So you mentioned diversification and to look at the market in 2 to 3 years' time. So is that why 2 to 3 years' time? Is that when you're planning on selling the units, or is there
Yeah. So okay. Firstly, I'm not suggesting that anyone can predict what's going to happen in 2 to 3 years' time, but you should at least have a view. You should have a look at what you think that the trends are that are going to influence where things are going to be in 2 or 3 years' time. What I'm saying is that typically a development, from the time that you might start looking at a site to the time you've got finished properties, it's going to be probably 2 to 3 years, because by the time you get the thing through planning, you get your contractor lined up, you get it actually developed out, and you make sales. That's how long it's likely to take. So the Lockway House in Gloucester Docks, the project that I showed in my presentation, that took us 7 years before we finished it. So we bought it in 2006, before the global financial crisis. We got the planning in 2007. We had a tenant in it, so that actually paid for the cost of sitting on it. But we couldn't start developing it until 2011, and then we finished in 2013. And we've still got 3 properties in that building. So, I think you have to think in... you have to think in terms of a 2 or 3 year cycle for a development. I mean, if it's a smaller development, it's just a refurb, you might get it done in 6 months. But if you're not thinking in those sort of timescales, you're probably not being realistic about how quickly things are going to happen. Yeah. Okay. Anyone else? Yeah. Go for it.
Because of those reasons that you mention, and with potential change in markets, I've been consciously moving away from new build recently and only going for what I call redevelopment. So either permitted development or full planning, but within the confines of an existing building. You seem to be going directly for the new build, but adding the value with the sort of the change in planning from the planning outline, which I thought was a really, really interesting concept. Is there anything that you're specifically looking for when you see a scheme that has outline planning that you think, that's the bit I really want to look for that will make you delve into a site? Or is it just anything where you think that you can add value based on the outline consent?
That's a good question, and I'll answer it in two ways. With certain types of site, you see the same things over and over. So typically on outline planning consents, in my experience, maybe 30 to 40% of them are not reflective of the value that can be extracted from a site. Now, that's a sort of a forward-looking statement. In other words, what I mean is you look at the consent and you think that it's got potential. Now, whether you can realise that potential or not is something that you don't know when you acquire the site. So with the Gloucester site, when we bought it, we thought it had that potential, but we didn't know that. We only knew it after we'd actually got the planning consent. So we turned out to be right. But that's, I guess that's a reflection of experience, of having looked at other sites and seen what had happened on them. So I think to take it to sort of urban sites, again, it tends to be the same sorts of things. You know, can you get basement space in? Is there an opportunity to go up? I mean, with tight city centre sites, there's usually only 3 ways or 4 ways that you can actually increase end values. You know, one is going up, one is going down, another one is trying to fit more space within the existing approved envelope. So, floor to ceiling heights, is the whole thing optimised? The other one can be to look at what you're doing in terms of units. So, if we did a residential scheme on that site in Kennington, we'd look at the unit mix and we'd try and optimise the flats down to the minimum possible size for each type of flat. So the point really is that a 3-bed flat in Kennington, you might sell for £700 a square foot. A studio, which is, so a 3-bed flat would be maybe, 900 square feet. Studio, which is say 400 square feet, you might get £1,100 a square foot for. So there's actually a 40% difference in pounds per square foot in values depending on the size of the flat. So if you can optimise the size of the flats down and you can get more smaller units by doing that, and you can free up floor space to do that, you can actually enhance your end values as a result. Yeah. So, my point really is that the way to do it depends on the kind of site that you're looking at, and the 2 main types of sites are tight city centre sites and rural sites where you've got multiple houses on them. But sites come along in all sorts of shapes and sizes. But what looking at lots of sites does is it gives you a feel for the sorts of things that you're likely to see, the patterns. It's kind of a pattern recognition thing, and the more you look at it, the easier it is to see them. So when I look at sites, I can quite easily see the patterns, and I might not necessarily know, but I might have a very strong suspicion that there's something in there which will cause me to investigate it further. I might look at other sites and I can see immediately that it's been fully optimised, and so I write it off. So, it's something, it's a sort of a practice makes perfect thing. Going back to the analogy of riding a bike, the more you do it, the more you practice it, the better you get at it. Yeah. Sure. Yeah. Sure, yeah.
Point. So you mentioned you find opportunities where they've bought planning for outline planning permission. What about where they've got full planning permission? Have you found there's opportunities there, or is it not worth?
No, it definitely is. So the site in Kennington has a full planning permission, but it's a very badly optimised planning permission. So it doesn't take full use of the approved massing, and it didn't, for example, include a basement. That was one of the immediately obvious opportunities. It may be possible to get multiple basements on a site like that. So what we look for is sites which have a consent, so that we've got a fallback that works. I mean, if you operate on the principle that if you buy something and just implement the planning that it's got, you're probably not going to make a lot of money, because people will value the site based on that, and you might make at most 20% profit on cost. But if you can buy that site and your fallback position is the existing planning, but you think it's got opportunity for enhancement, you're limiting your downside, but you're also giving yourself a lot of upside opportunity. Now that's a good bet. So if you buy 5 sites like that, and 4 of them you get your enhancement on, and 1 of them you don't, overall you're going to do very well, because the value of that upside is significant.
But the problem with that is, the follow-on to that would be it's going to be a lot more difficult to fund a site which it has 20% profit on cost, when most of the funders are looking for 30% profit on cost.
Okay, so it depends where you are in the country. So in London, lenders and valuers will generally accept a lower profit on cost. Maybe not at the moment, but certainly historically, when the London market has been more active, because it's easier to sell properties ultimately. I guess the answer to that is you need to bring in equity if the deal doesn't work based on the way that it's set up at the moment. And so it is one of the reasons that we've worked with investors, that we've worked with equity investors, because it means that we're not so reliant on debt, and that helps to kind of de-risk the thing in other ways as well. Yeah.
Sorry, just on that, where you're looking at sites with either outline or full planning, but you see the potential to enhance the value, what's your advice in terms of how you go about structuring the purchase of that? Given that you purchase a site, can't start straight away, there's a time lag. What's your advice on that?
Okay. So, I mean, when it comes to development and development finance, then obviously time is money. Obviously, the best way to buy a site is on an option, because then you can exercise it when you're ready, or maybe a subject to planning option if it doesn't have the consent you want. The problem with that is that most vendors won't do it because it's too open-ended for them. So, I guess the two other sort of key tools that I would suggest are an exchange with completion subject to planning. Again, hard to get a vendor to agree to that, but they might, or just a delayed completion. So you buy yourself time instead of having to complete in 4 weeks or 6 weeks. Maybe you can complete in 6 months or a year. I mean, sometimes what vendors want is certainty about the sale. So they, especially if it's an investment property where they've already got a tenant in it, they're getting an income from it, they're probably not going to be that concerned about how long it takes you to complete. So if you can exchange on something, you'll be taking the risk as to whether you can get an enhancement to the planning in between exchange and completion. But if you can, you may be able to actually exchange on it, and then by the time you complete, you might actually end up with something that's worth more than you're paying for it. But those are the ways to do it. It is certainly difficult. It's more difficult to get vendors to agree to conditional offers. There's one approach you can take, which is an interesting one, is you can put multiple offers forward on the same site. So you can put an unconditional offer forward at a certain level, and you can put a conditional offer forward at a higher level, and then the vendor can say, okay, well, I want 1.2 million for the site, but I'm only going to get that if I accept this conditional offer. Then they're looking at 2 alternatives, and if they're looking at different alternatives and they realise there's a financial difference between them, it can sway the decision. So that's one approach to take. Yeah.
Just another question. For someone who's looking to kind of scale the development side of our business, what advice would you give?
I think it probably depends to a large extent on where you are now. Just tell me a little bit about what you're doing and what size it is.
So we've got multiple projects in planning, range from 1 house to potentially 20 units, but that's very much kind of a new side of our business. Historically, we've done developments, but they've been quite kind of small scale and always linked to our investment portfolio.
So what sort of scale have they been doing, the ones you've been doing?
Yeah, so they've always been under 5. But because our focus has been on building our HMOs and commercial mixed-use portfolio over the last several years.
I think my advice, if you are thinking of scaling the business, would be to partner with somebody who can help you do that, because doing developments of less than 5 units, you will have picked up some experience, but if you want to minimise the number of mistakes that you make on larger schemes, it's better to partner with somebody that's done them. That would be the best advice I can give you. But there are lots of developers out there, and we do this sometimes, who will partner with an investor who has a site and then work with them to develop it out. So if I'm happy to look at stuff if there's something you want to put in front of us. Yeah. Okay. Yeah.
Follow on from that. So, what are the benefits of, in essence, JVing with another developer compared to investing in your team, in essence, the planning consultants and architects? I mean, what additional value, and I know there is additional value, of course, but what are the key elements that a developer would bring in that a planning consultant or an architect couldn't help with?
Probably the best metaphor that I can give you is that of the conductor of an orchestra. So the conductor of an orchestra doesn't know how to play the violin. He doesn't know how to play the oboe. He doesn't know how to play the drums. We might do, but probably not as well as the people in the orchestra. Those people all have individual skills, and it's the same in development. A planning consultant has a specific skill. A builder has a specific skill. And a quantity surveyor has a specific skill, but their skills are confined to what it is that they do. One of the mistakes that I made quite early on was to assume that builders knew how to do development. They don't. If builders know how to build stuff, but there's a whole bunch of other stuff that you come across on a development that builders know nothing about. They don't understand how to structure development finance. They don't understand how to deal with marketing and sales and the implications of new home warranties. They don't understand things like road adoption and dealing with planning conditions, because they normally don't have to deal with that stuff. So I think the thing that a developer does that's unique is they take the process from beginning to end. And all of those other people just simply play a part along the way. So unless you have experience of doing that whole process, you won't understand how it works end to end. So one thing that's probably worth saying is we crowdfund equity for our developments, and we work most closely with a crowdfunding platform called Crowd With Us. And one of the reasons that I work with those guys is they have done developments themselves. And so what that means is that they understand better than any other crowdfunding platform how the process works. And so they do that gives them two things. Firstly, it means when I talk to them about a development, they understand what I'm talking about. I don't have to spend a long time explaining to them, what a specific element of a development is. But they also know the questions to ask me to be able to do their due diligence properly, which actually gives me confidence in them, and it gives investors confidence in them. So I think having that background is something that you can't have unless you've done it. So I mean, maybe if your planning consultant has worked as a developer, then perhaps they could do that piece of it. But that end to end, that sort of experience of the end to end process is the key thing. Yeah.
There's also the financing element. If you've never done a development, you could have a great team around you, but the bank, if you're the one that's wanting to raise a development finance, the lenders are very unlikely to if you've never done a development, whereas if you've worked with a developer, you've now got the actual first-hand experience. Yeah,
actually that's a really good point. So one of the things that was really quite hard for me when I did my first development was raising development finance, and what I mean is, actually, when I say that, is I mean convincing the development lender that they should back me, because their biggest concern was I'd never done a development before. And so the first one I did was relatively small. It was actually financed by United Trust Bank, who was still around as a development lender. So I went on from that first relatively small one to do another much bigger one. So the first one I did was a conversion of a house into two houses and a shop into two shops, and then I got planning permission on a piece of land out the back. And actually, I didn't make any money on the actual conversions. I made my money on the planning consent I got on the plot. But what I did do is I learned and I built up a track record. And then the next project that I jumped into, I mean, I was doing a few other things, but they were stuck in planning, was an 11-house new build, which I did, which I wanted to do. The bank basically said, we're not going to lend to you unless you get a partner on board who understands what they're doing. So I did that one as a joint venture with a builder. And what that taught me is that builders don't understand development. So I made a lot of mistakes on that, but I would have made a lot more if I didn't have him on board, because he did fill in the gap in terms of understanding of how construction works that I didn't have. What it made me realise is that there was a bunch of other stuff that he didn't know, and I had to learn and work that stuff out. So it could have gone a lot better if I'd known that stuff, but I think we did make some money out of it, but not as much as we could have made if we'd done it properly. It's the value of experience. Yeah. Sorry. Yeah.
So what's that bunch of that little stuff? What's that bunch of that little stuff that your builder didn't know, and you didn't know, and you had to find out along the way on your first project?
I'm not sure that I can remember everything, but here's a couple of things. We rushed on site very quickly to start building things, and what we probably could have done if we hadn't been in such a hurry is we could have put in some revised planning applications and actually enhanced the value of the site. The site actually had capacity for more houses than we ended up building. So actually it was an outline consent for 10 houses. We actually ended up building 11 because halfway through the project I realised actually that we could actually enhance the consent by putting more houses in there. But by the time we'd got to that point, we already built half of them, and so it was a bit too late. I think in retrospect we probably could have got 14 or 15 on there, and so that would have made the scheme a lot more profitable. So that's one. Another one is I didn't understand what was required in terms of road adoption. So halfway through the project, I got an APC notice slapped on me. That's how I know about them. And I ended up having to deal with that while the development was underway. So that was one lesson I learned that I haven't repeated. There was a bunch of other stuff, and a lot of it is lost in the mists of time because it's if I went back and looked at the project, I'd probably remember it all. But on a project like that, you do learn a lot. On the construction side of things, we did pretty well. We did that in timber frame, and that was, I guess, it was a reflection of the builder sort of and I sitting down between us and working out what the most cost-effective way to construct the thing was. What did come home to me is that although this guy knew how to build stuff, and he knew how to build the individual houses, what he wasn't so good at is managing the process on a multi-site development. Building 2 or 3 houses and managing the logistics on a site like that is quite different to managing the logistics on a 10 or 12 unit site. And I think the bigger the sites get, the more that kind of project management and logistics management becomes important. You just need that process and structure to make it work. Otherwise, things end up in a mess. Stuff gets lost, it gets stolen off site. People end up wandering around not knowing what they're doing. You have to schedule the trades in, and you have to plan it very carefully. If you're doing one house, it's not quite the same. You've only got one set of stuff to plan. If you're doing 10, you've got to plan 10 all in simultaneously. You want to be moving trades from one house to the other. You want to be lining things up so that you don't have some materials delivery happening while you're trying to put timber frames up. It's all about coordinating stuff, and if you don't coordinate it, you end up losing time and it costs you money. Yeah.
Where do you see as the key opportunity areas in terms of the new PDs or industrial buildings, for example?
I'm probably not the best person to ask that question because I haven't done any office to resi PD. Only on a very small scale. It's certainly not been our focus, and I think that market is actually reasonably well saturated. I know there's some new sort of light industrial to resi PD rights and various others coming along.
It's already in place.
Yeah. Well, sorry, it was just recently came along, I guess. Yeah, but I don't know. I mean, a lot of that stuff, that industrial stuff, is located in odd places.
Too far inside.
Yeah, and so if you're looking at residential conversion on something that's in an industrial park, it's kind of hard to see how that's going to work from a saleability point of view. I don't know whether you'd even get your So I mean, some of that might be a bit odd, but I'm probably not the best person to ask that question. It's not really something that we do a lot of. Yeah.
I suppose more widely in terms of those were just examples, but in terms of co-living, but different types of products from diversification point of view. What are your thoughts on that?
Yeah. Okay. So that's definitely one I can answer. I'm going to give you guys a chance to ask some stuff because these guys have been talking a lot. But So look, there are two trends that I think are really important in the property market at the moment. One is the rise of co-living, and that's really HMOs on a large scale. So it's sort of scaling up that HMO model. But the other thing that I think is very interesting, particularly in the UK, is and in Europe actually generally, is apart hotels. And apart hotels are really serviced accommodation on a bigger scale. So it was sort of kicked off by the whole Airbnb, TripAdvisor / home away type thing, and that's migrated into operators starting to build pipelines of apart hotels at scale. So you've got operators like Sacco and Stay City, and a few other operators that are starting to build up portfolios. People like Room 2 and Rooms, and they are. Rather than being hotels, they are hotel rooms which got a kitchenette in them, or a proper one-bed apartment. They're designed for longer stays, so people tend to stay in them for maybe 4 nights or a week rather than just 1 or 2 nights, and that's a market that's really well developed in Asia and the US, but not in Europe. And so these companies are growing very quickly, and they're looking for premises to put their businesses in. And so that's what we've tapped into with the development that we're doing in Kennington. And we're looking at hotel sites actually, or apart hotel sites in Bristol, also in Birmingham and Liverpool at the moment. And actually, we'd look at apart hotel sites anywhere in the country. And those don't necessarily have to have a hotel consent. They could have a residential consent, which could be converted to a hotel consent. The thing we like about it is that there's a bunch of stable operators out there that will take pre-lets on them that you can then forward fund. So it's a nice model, and it's got you've got a guaranteed exit. So that's something that we're very interested in. Student living and co-living, I think, is also very interesting. Co-living is not really well established as an asset class yet, but I think certainly it's coming, and it will grow more. Yeah, it's one to keep an eye on. Yeah.
So hi, my name is Andrea. How do you structure the deal with the apart hotel operators? What do you look for in them, and what they look for in you?
So the key thing in committing to an operator is, do they have a fundable covenant? In other words, do they have the financial strength and the track record for an institutional fund or a pension fund or somebody like that to actually buy the finished development? And so the best way of assessing that is there a track record of deals in the market that pension funds have bought? So with Stay City, that they've got a track record of something like 15 sales to pension funds. You can look at what the yields those sales were made on, and so you can fairly easily assess what a lease to them would sell for in a particular location. The more established hotel operators like Travelodge or Premier Inn, Premier Inn is backed by the Whitbread covenant, which is very, very strong. So, the yield on those sales is lower, which essentially means the value that you get, the end values are higher. Do you understand how commercial yield works? Is that something that's worth explaining, or some of you guys do? Or
I think it'd be useful.
Yeah. Okay. So, in essence, yield is based on the return that an investor would expect to get if that investor bought that investment. So, to take an example, if you sign a lease with an operator and the income on that lease is £1 million per annum, then if the covenant strength of that operator is sold at 5%, then essentially it means that you're getting 20 times the annual income. Does that make sense? So you're effectively dividing the income stream by the yield. So in essence, from the investor's perspective, what it looks like is if they buy that investment for £20 million, they're getting a 5% return per annum. Okay, so in essence, what you're saying is that this covenant has a certain strength, and you're valuing the rental stream by dividing the annual rental stream by the yield. Yeah. Yeah, sorry.
So basically, £1 million lease with these operators could be sold to an investor pension fund for 20 million.
Yeah, exactly.
Pretty much.
Yeah.
Is that what you're saying? Yeah?
Exactly. Well, so Stay City's covenant is currently running out at about 4.5%. So, and the lease that we will sign with them on the Kennington site will probably have an income of about £1.6 million, something like that. So that comes to something like £40 million. Yeah.
Sorry, me again. So for operators starting out now, what would you recommend to do? Because of course a small operator doesn't have that kind of strong covenant that you can base your development on.
Sure. Okay. So there are smaller operators around, and so there are opportunities to do stuff with some smaller operators, but you do have to get to a certain scale before you can take advantage. So I mean, the apart hotel market might not be for everybody, because you might not be able to get to a scale where you can take advantage of it. But there are other opportunities in different sectors with smaller commercial premises. So that one might not be the one for you. There are other residential markets which are not quite as flat as the London market at the moment. But I think my personal view is, if you're looking 2 or 3 years out, what London is doing at the moment represents a buying opportunity. I think if you're getting involved in a property project, you need to make sure that you're not in a position where you're forced to sell. You need to make sure that you're in a position to hang on if you need to. Now, there's lots of ways to do that, but one is to buy a property that's got an income on it and make sure that whatever that income is covers the debt servicing cost. So I think my personal view is that once we get Brexit out of the way, in whatever form, we are going to see some level of confidence return to the market. But you've got to make your own mind up about what you think the market's going to do. That's you might take a more conservative view. I think at some point, the one thing I can tell you is that at some point the market is going to go up again, and also that at some point the market's going to crash. I just can't tell you when. I can tell you what I think, but I may be wrong and I may be right. Yeah.
Sure. Evan, I'd be quite interested to hear what kind of exit strategies you have in terms of like plan B, C and D, maybe, in case something goes wrong or overruns or costs increase.
So 3 separate things there. What I tend to do is to look for developments where, if I can't develop them out, if I can't sell them, then I can refinance and rent the completed units. But it does depend what the finance structure is on the project and who I'm working with. So on the Kennington project, we're working with a partner who has very deep pockets, and so if we got to a situation where we're unable to sell the completed development, they would be happy to hold it as an investment. So that's a situation where we're not exposed with our own money, if that makes sense. And so I would take a different approach. I'm not saying I would take a more risky approach. I certainly wouldn't. But it depends on that partner's ability to support whatever it is that we're doing. Yeah. And so the risk profile that they're prepared to live with is a factor. What I have tended to try to do in the past is, where I'm buying sites and there is some planning involved, I try and buy something where there's an income on it, so that I've got some money coming in to cover the debt servicing costs while I'm getting the planning in place. It's not always possible. I think for me, certainly outside London, probably houses are more risky, because the yield on houses is lower than the yield on flats. And so if you're thinking about fallbacks, then developments of flats are probably less risky, because you're more likely to be able to refinance and rent them in the event that you can't sell them. So, but I think ultimately it's about having a balance of risk within your portfolio. And so I'm in a different place now to where I was when I got started. When I got started, I was much more reliant on each individual project. I now have an investment property portfolio and an income from that I can rely on. I've got a balance of projects in different parts of the country. I've got equity investment in a lot of those projects, which allows me to deleverage them. And also exposure to different market sectors, not just residential but commercial sectors as well. So I suppose it's probably the best way to answer it is to say that as my business has changed, my approach has changed. So, and I think you have to take an approach that's appropriate for where you are in your business at a particular time. If you're only doing one project and you're reliant on that single project, you probably want to be thinking more about risk mitigation in terms of that individual project. If you're doing multiple, you might want to be looking across the piece. Does that make sense? Yeah.
Just linked to that, really, I think you multiple exit strategy in terms of at the initial stages. So when you're appraising the site, do you appraise the sites based on multiple exit strategies, and therefore do you tend to work with funding partners who are flexible in terms of, let's just say that if you're building to sell and then you have to hold, what tend to be your approach around that?
Yeah, so I think if you're working with a funding partner, the more sophisticated the funding partner, the better. So one of the reasons that we ended up doing this Kennington project with a family office is that they have a specialism in real estate, and so they understand real estate really well, and they're able to cope with multiple possible outcomes. A lot of investors, particularly if they don't have a lot of experience, they want it all black and white. We're going to do this, and the outcome is going to be that. The reality is that property development isn't like that, particularly when you've got planning uncertainty. You can't say with certainty that the planners are going to like X, Y, or Z. You can go to a planning consultant, you can ask them, you can get a pre-app. Even a pre-app doesn't guarantee you what's going to happen, because particularly if you've got a large application and it goes to committee, it could go to committee with a planner's application to turn it down, and they could approve it, or vice versa. So there's an enormous amount of uncertainty in the planning process, and so I think if you're working with a funding partner on a larger or more complicated process, it's better to be working with somebody that's experienced, because not only can they actually add value, they can bring you some context and expertise and insights maybe that you don't have, but also they need to be able to cope with the possibility of there being multiple scenarios. I was asked earlier about the Clapham Road project and the number of scenarios that we ran. We ran something like 7 scenarios, and they were all based on different possible outcomes in terms of planning. And there's still risk in that project, because we don't know what the planners will or won't approve. But we do know that we've got a fallback case that works if we can't get anything more out of them. Okay.
You mentioned in your presentation that 90% of the work should be, you should be prepared and plan before you even start on site. So what advice would you give to a new developer on how to make that preparation, and what are the most important things that we need to look out for?
So one of the things that will happen on a development project, if you don't have everything specified at the outset, if you're engaging a builder, is you'll end up with variations on your build cost. And what tends to happen when you go out and get quotes to do a piece of building work is that builders will quote very competitively for the initial piece of work, especially if they know that you haven't got everything tied down up front, and they will look to make their money on the variations, the things that haven't been included. And so I think a lot of it is the problem is that in a building project, there is an immense amount of detail. There's a lot that needs to be done. You're going to be digging out some ground, you're putting some foundations in. Those foundations could be in lots of different forms. They might be piled foundations, they could be trench fill foundations, you might have a raft foundation, then you're putting something on top of that. Is it going to be masonry? Is it going to be timber frame? Are you going to need steel to reinforce it? So all of that stuff that goes into actually constructing something, if you don't specify that in advance, in a way, that's an opportunity for a builder to say, well, you didn't say what that was going to be, and so, it's not what I quoted for, and so I'm going to charge you for it. Now, one way to get around that on larger scale projects is to put a design and build contract into place. And I don't know how much you guys know about design and build versus traditional contracts, but in essence, what a design and build contract does is it throws the detailed design risk over to the contractor. So in essence, what you say is, well, I think the best way to explain it is to talk about the way that traditional building contracts work. So you get your planning permission, you've got your layouts, and then you get your architect to do a detailed design, detailed drawings that show exactly how the thing's going to be built. And typically you'll also have a structural engineer involved, because you'll usually have some structural aspects. Maybe they might design the foundations, and there might be some steel beams and things that need to support weights above them, etc. So you get your set of detailed drawings, you give those to the building contractor, and then the building contractor says, how the fuck do I build this? Because the problem is that architects are great at designing stuff, but they never actually build things. They're not builders. And so what they don't connect is that there's the practical aspects of building with the theory of what they've drawn on the drawings. And then that means that those drawings have to be changed. Effectively, the detailed design has to be changed, and the person that ends up paying for that is you. So what you do with a design and build contract is you have a set of layouts, planning drawings, you set your specification in advance, and then you give that design risk to the contractor. So he or she engages the architect and the structural engineers and any other design consultants that are required. And if there's a discrepancy between the drawings they produce and what actually has to be built, that's at the builder's risk. So I think there are ways to sort of to minimise that design risk. And I can't remember where we started with this question, actually. What was the question again?
As a new developer, what do we need to look out for before we start? What are the preparations that we need to make?
Yeah. So I think really the answer to the question is you need to think through everything that you can up front in terms of specification. And what you can do with a design and build contract is you can push those technical building issues back to the contractor. And essentially you say to the contractor, you deal with that technical building stuff, the stuff that goes inside the shell of the building. I don't want to know about that. And you can set aside the things that you want to have influence over. So maybe the kitchen layouts, the bathroom layouts, the flooring, the aesthetic elements of the build, the things that actually make a difference to the people that are buying the properties. I mean, at the end of the day, most of the structure of the building you probably don't care about. You might care about whether it's timber frame or masonry, because masonry is a more solid structure. If you want to use, for example, underfloor heating, you're probably better off with masonry construction than you are with timber frame. But apart from some sort of very specific things like that, you're going to be mostly focused on the aesthetics. But clearly, a very specific, say, door handle is going to be more expensive than just a standard Travis Perkins off-the-shelf door handle. And if you don't tell the contractor, they'll just price the cheapest thing. And so if you want to change it, you're going to have to pay for that. So what I'm trying to say is, if you want certainty, go through the detail up front, specify everything. And the more projects you do, the easier it gets. We have standard specifications for kitchens and bathrooms. We change them from project to project, but we can reuse the work that we've done on one project on another. So I suppose that's another reason for starting off smaller and doing bigger things. You can develop your kind of templates, and once you've got those templates and stuff in place, you can use them to actually create a template to do bigger projects, to do multiple versions of that one thing or two things that you've done.
For a development for a block of 3 flats, do you think I should use a design and build or just a JCT?
Where's the project? Croydon. If you can get your contractor to do it on a design and build basis, I would recommend it. That's sort of on the cusp of is it worth getting somebody to do it on a design and build basis? Is it new build? Yeah. I think it would be preferable to do it on a design and build basis. Contractors can Contractors sometimes don't like design and build because it pushes the risk onto them. So in a tight market, which it probably isn't in London at the moment, then it can be difficult to get contractors to do stuff on a design and build basis. I think I would push for it. If you can get it, then I would. It certainly de-risks what you're doing and it creates less work for you.
Right now, I'm not sure if I should get my architect to do like the technical design. So the detailed design, because I think I've sort of like asked them to do it, and the structural engineers and all that, because some people are saying the more detail you give to them, like the foundations, we're trying to, should we do our own, the test to find out what sort of foundations we need, and so that we can give all this information to the contractor as this reduces all this uncertainty, so that they know what exactly to quote for.
No, it's a good point. So there's a trade-off there. So if there's uncertainty about what the former foundations are, then you should, actually in any circumstances, you should give a geotechnical report or a borehole survey to the contractor so they know what they're dealing with. Because again, if they don't, they can come back and say, well, we didn't price for that, we priced for something else. Contractors generally won't take risk on things that they don't know about. So I think when you're doing design and build, you need to help contractors de-risk it by providing them with a lot of as much information as you can up front. And I think also, there is different degrees of detailed design. So you can give, under a design and build contract, you can give a contractor a very detailed design package so that you are very specific about what it is that you want. It doesn't prevent you from you doing it on a design and build basis, but you have to remember that the more detail you provide in terms of the design, the less flexibility you give to the contractor about to be creative, to actually do it in a different way to reduce cost. Part of the point of design and build is you say to the contractor, you do it as efficiently as possible. One thing I would do is I'd get a quantity surveyor involved to put the specification together, not an architect. Architects are great at design, but they don't have the same practical experience of building contracts that quantity surveyors do. So definitely get a quantity surveyor involved. Yeah. Okay, I think we're probably done for this session, aren't we? I don't know. Are we? You guys want to ask any more questions?
Final question.
Yeah, go for it.
All together. So you mentioned during the last crash you were still developing. So how did you survive the last crash, and how do you plan on surviving the next one?
Okay, so I did a little bit of development through the last crash, not much though. I did pretty much stop because there was a period during which you couldn't actually finance any development at all. I did do a small development in London, a commercial to resi conversion in Fulham in 2009. But really, the main way I survived was because I'd built up an investment property portfolio. Interest rates came down significantly. A lot of my mortgages were base rate linked, and so I ended up with very low mortgage servicing costs and quite good rental income. So was that good planning or was it luck? It was probably a bit of both. I think if interest rates had gone up, I would have been in trouble. How do I plan to survive the next one? I don't know what form the next recession is going to take, but what I do know is that the best way to guard against turbulence in the market is to diversify. So I guess you could say I'm actively focused on diversifying my business. Not being focused on a particular end market, making sure that I've got multiple elements to my business. So not just development, but also investment property, de-risking by bringing in equity. So I think lots of different elements, but I think you can't predict exactly what's going to happen or what form of crash is going to come in. And so all you can do, I think, is a bit like with investment, you don't want to put all your eggs in one basket, so you spread it across different things, and it means that if one thing doesn't go so well, you've got something else to fall back on. Yeah. Great. Thanks, guys. Thank you very much.